You know, in the wild world of day trading, it's so easy to get overwhelmed. But what if the real key wasn't about trading everything that moves, but about mastering just one specific high-probability setup? Well, today, we're going to break down a strategy that does exactly that, the gap and go.
So, what if I told you that this number, a jaw-dropping $8.8 million, was made primarily from that one single type of trade? I know, it sounds almost too good to be true, but the data tells a pretty amazing story.
So this isn't some random theory. We're looking at a real-world example from prominent trader Ross Cameron's portfolio. Out of $9.5 million in gross profit, look at this. The overwhelming majority came from just one category, gapping stocks. It's a massive outlier, the one thing that made almost all the difference.
And hey, don't just take my word for it. Here it is, straight from the source. I make the majority of my profits trading stocks that are gapping up. That is why you must understand how to use a gap scanner. This really sets the stage for why this one skill is so incredibly important to understand.
Okay, let's dive right in. Before we can even think about trading this stuff, we have to get the mechanics down. So what in the world is a stock gap?
At its core, a gap is basically a sudden repricing event. A stock closes one afternoon and then bam, the very next morning it opens at a way higher price. It creates a literal gap on the chart. And this doesn't happen by accident. It's almost always because some big news, like a huge earnings beat or a major FDA approval, came out overnight.
And here is a textbook example. You can see this stock closed the day at $7. Then some great news hits, and at the opening bell the next day, it's already trading at $11.85. That's a massive 67% jump before the regular market even gets going.
But here's the million-dollar question, right? We see stocks gap up all the time. So what's the secret ingredient? What turns a simple gap into one of those truly explosive rocket ship moves, while so many others just fizzle out and fade? Well, the answer comes down to something called float. And this slide gives us the perfect analogy. Think of a huge stock like Bank of America, with its 7.5 billion shares available to trade, as a massive cargo ship. It takes an unbelievable amount of force to even move it an inch. But a low-float stock? That's a speedboat. With only 1.6 million shares out there, just a small burst of demand can send it absolutely flying.
So it all boils down to this super simple but incredibly powerful formula. When you combine low supply, that's our nimble little speedboat, with a sudden surge of high demand, which is driven by that breaking news, you get the perfect recipe for extreme volatility. This right here is the engine that drives the entire gap-and-go strategy.
Okay, so now we get the theory, right? We know what makes these things move. Let's get into the actionable playbook that traders use every single morning to actually put this strategy into practice.
The entire process really breaks down into 3 simple steps. First, you scan the market to find potential runners. Second, you filter that list down to find the absolute best setups. And finally, you execute your trade with a precise entry plan.
Step 1 is all about the hunt. And this happens in the pre-market, usually in that golden hour between 8 and 9 a.m. Eastern. You're using a tool called the gap scanner to find the stocks that are already gapping up big, ideally 20% or more. But, and this is important, just because a stock is gapping doesn't mean you should trade it. Step 2 is all about filtering out the noise. You take that long list from your scanner and you narrow it down to just 3 to 5 A-plus candidates. You're looking for a stock in a specific price range with a really low float and, this is critical, a ton of pre-market volume. That volume tells you the interest is real. Okay, we've found our target. It checks all the boxes. Now for what is probably the most important part. How do you actually get in the trade? Because the biggest mistake people make is chasing, just jumping in while a stock is already screaming higher. That's a recipe for disaster. You need a disciplined plan. So the first discipline entry is called the pre-market high break. It's simple. You just look at the chart and find the highest price the stock hit during the pre-market. You don't buy yet, you wait, and you only enter if and when the price breaks above that level. That breakout is your confirmation that the buyers are still aggressive and in control. The second trigger is a classic called the dip and rip. This one is designed for that crazy volatility right at the 9:30 open. A lot of times, a stock will have a quick little sell-off right at the bell. It's called a shakeout. The plan here is to patiently wait for that dip, and you enter the moment the price pushes back through the opening price and turns green. That's your signal that the sellers are getting exhausted. So what happens if you miss that first big move at the open? First rule, don't panic, and whatever you do, do not chase it. That brings us to our third trigger, the first pullback. See, after a strong run, a stock usually needs to catch its breath and will trade sideways for a few minutes. That's called consolidation.
Your entry is to buy as the stock breaks the high of that little sideways range, which often signals the next leg up is starting.
Now we've talked about all the good stuff, but a setup can look absolutely perfect on paper and still turn into a disaster in a split second if you ignore the other side of this coin: risk management.
And this is so important. A gap is not a guarantee of success. Look at the left. The winner, INDP, gapped up and then powerfully broke through a key resistance level. That's the go signal. But look at the loser on the right, MOSY. It got slammed down right at that resistance line and sold off hard. The lesson here is absolutely crucial. You have to trade the technical breakout, not just the gap itself.
Success with this strategy is all about quality over quantity. As the quote says, this isn't about taking 100 trades a day. It's about finding one or two really good ones. That means you have to be super selective, and you must have a clear exit plan before you even get in. Know where you're taking profits and know exactly where you're cutting your loss if the trade goes against you. No exceptions.
And then there's the mental game, which might be the hardest part. This chart tells a story we've all seen. The trader has an amazing first 30 minutes, banking over 100 grand, but they keep trading. The market gets choppy, they get faked out a few times, and they start giving all those hard-earned profits back. Greed kills in this game. True professional discipline is knowing when you've hit your goal and just having the strength to walk away.
Okay, I know that was a ton of information, so let's put it all together and recap the entire process from start to finish with a simple checklist you can use to guide you.
Here it is, your 6-step checklist for putting this strategy into play. Every morning, you scan for the gappers, you filter for quality, and you map out your key price levels. Then, you execute your entry based on a valid trigger, you know your exit for both profits and losses, and finally, you have the discipline to stop trading for the day, especially when you're winning.
And this brings us to the final and most crucial point. This entire strategy hinges on speed, on pattern recognition, and on precise execution. So the ultimate question isn't whether the strategy works. The data is pretty clear that it can. The real question is, do you have the discipline to master it in a trading simulator, to practice it over and over and over before you risk even a single dollar of your real money?